Today, Congress hauls in three titans of big tech, Zuckerberg, Dorsey, and Pichai, and grills them on their plans to combat misinformation on their platforms. Plus, some junior analysts on Wall Street took a stand against their 100-hour work weeks, and now investment banks are lining up to hand out perks. And finally, investing heavyweight Fidelity wants to sponsor a Bitcoin ETF, though it's unclear if the SEC would sign off. I'm MacKenzie Sigalos, and this is CNBC After Hours. Stocks staged a recovery today as all three major indices finished in the green. Bitcoin prices, on the other hand, fell lower. The cryptocurrency has been struggling recently, and the value has declined more than 9% in the past week. But that isn't stopping investing giant Fidelity from getting more involved in the crypto market. Now, just yesterday, the firm filed paperwork for a Bitcoin ETF, or exchange-traded fund. ETFs are an accessible and popular way for everyday investors to gain entry into financial markets without having to pick specific single securities to purchase. The crypto industry has been pushing for an ETF for a long time now, but the SEC hasn't approved one yet. Kate Rooney explains.
Fidelity is applying to launch a Bitcoin ETF in the latest sign of the money manager's commitment to crypto. This is through a subsidiary of Fidelity. The ETF, if approved, would track the price of Bitcoin. And the crypto industry has been waiting for an ETF to get the green light. They say it's another entry point for Bitcoin investing, and there have been plenty of applications, including one just last week from Van Eck, but none have been approved by the SEC so far. Fidelity has really been a pioneer in the crypto space, led by its CEO Abigail Johnson, whose grandfather founded the company 75 years ago. Johnson has talked about her interest and support for crypto, and I'm told she is really the driving force behind the firm's initiatives. That has included launching a separate company, Fidelity Digital Assets, 3 years ago, to handle custody and trades. Fidelity also has a partnership with Coinbase so investors can check their balances and make charitable donations in Bitcoin, and it lets people pay with crypto in the Fidelity cafeteria. Johnson also drove a project to start Bitcoin mining in New Hampshire. Back when the crypto's price was around $180, it's now trading around $52,000. The crypto industry has been advocating for an ETF for a long time. They say that it's easier in some cases to get exposure to Bitcoin prices without actually holding the cryptocurrency themselves. So for average retail investors, they say it could be easier. But since this Bitcoin ETF effort really started, there have been a lot of other ways that have popped up that might actually reduce the need for a Bitcoin ETF. You have the Grayscale Bitcoin Trust, which is sort of seen as a proxy for investing in Bitcoin. There's also things like PayPal recently launching the ability to buy crypto. So since that effort really started, there's other ways that have popped up. So some say it's probably less important than it was 2 or 3 years ago. The SEC, meanwhile, has cited things like risk, volatility, investor protection for reasons that they have not approved a Bitcoin ETF so far.
Okay, today our Soundcheck is the Silicon Valley Goes to Washington edition. The CEOs of Facebook, Twitter, and Google all testified before the House of Representatives today in a hearing about how the executives plan to fix misinformation on their platforms. Here are the highlights.
We strive to have transparent policies and enforce them without regard to politics or point of view. Our ability to provide a range of information and viewpoints while also being able to remove misinformation is possible only because of legal frameworks like Section 230.
If we woke up tomorrow and decided to stop moderating content, we'd end up with a service very few people or advertisers would want to use. Ultimately, we're running a business, and a business wants to grow the number of customers it serves. Enforcing policy is a business decision.
The system isn't perfect, but it's the best approach that we've found to address misinformation in line with our country's values. It's not possible to catch every piece of harmful content without infringing on people's freedoms in a way that I don't think that we'd be comfortable with as a society. The second change that I would propose is creating accountability for the large platforms to have effective systems in place to moderate and remove clearly illegal content. So things like sex trafficking or child exploitation or terrorist content. And I think it would be reasonable to condition immunity for the larger platforms on having a generally effective system in place to moderate clearly illegal types of content.
Okay, so last week, a PowerPoint slide deck from a group of first-year analysts at Goldman Sachs went viral. The presentation detailed what they described as brutal working conditions, including condescension from senior bankers and 100-hour work weeks as the firm tried to keep up with demand amid the explosion in SPAC deals. Now, remember, SPACs are those blank check vehicles that take smaller companies public through reverse mergers. Well, they've become trendy, and there are a ton of them so far this year. And clearly, the entry-level bankers were fed up. Since the deck went viral, competing investment banks began handing out perks in an effort to keep their junior staff happy. Jefferies offered analysts and associates a choice of luxury fitness options, including a Peloton, a mirror, or a suite of Apple products. Citigroup banned internal Zoom meetings on Fridays. And yesterday, Credit Suisse handed out cold, hard cash, $20,000 bonuses for junior-level staff. The news has sparked a debate about whether Wall Street's workplace culture should change with the times, or if these college grads know what they're signing up for and why they're being paid so well. Hugh Son broke the original story of the Goldman deck last week, and he dove into this discourse for us.
It was interesting that these first-year analysts decided to stage a protest a little bit, but they did in a very classically Wall Street way, which is to create a pitch deck for their sorrow and their pain. And essentially, when you look at the deck, it talks about 100-hour work weeks. And I think the context here is, the first 2 months of this year have seen more SPAC activity, more IPO-driven SPAC activity than the entirety of 2020, the entirety of last year. And last year was a record as well for SPACs. So this year is already a record. These kids are in the perfect storm. They're all working from their homes. They're all feeling probably pretty isolated. They're perhaps working from their parents' basements. And yet they have to put in, truly brutal hours. We're talking about 100 hours, 105, 110 hours a week. And so you've seen this reaction in sort of each firm taking a different approach. Now, Credit Suisse, as others, and we reported yesterday, is taking the approach that, what people really want is money. If you come to Wall Street, you want money. That's just always been the case on Wall Street. And they're giving their first, second, third years a $20K bonus in the second quarter. And what's remarkable about that is they're giving a bonus for work that has really just begun. And so what that really tells me is they need to retain their folks. They need to retain their junior bankers because, as you can imagine, this onslaught of deal activity comes in, and they need to have their foot soldiers at the ready. The trade on Wall Street has always been, if you're a promising, young graduate, 22, 23, you are going to give up your social life, give up some aspect of your mental and physical health, to be honest, for, compensation that most Americans would only dream of. A first-year analyst at Goldman Sachs can make 150 to 200K. You'll have people who say, this generation is entitled and this generation is complaining. I mean, I look at it as, they recognize the value of their labor, and that, at this very moment, given the incredible deal flow, that they have leverage, and they're exercising that leverage. At Goldman Sachs, there's no sign that they're going to be giving them more money. What Solomon has said is that help is on the way, that they're hiring more juniors, that they're reallocating resources, they're going to try to respect, this pencils down, over at least one day of the weekend, protected weekends, and so that people can, have a slightly less onerous work-life balance at Goldman Sachs.
Okay, time for the numbers round. Let's kick it off with $9 billion. The mega container ship Ever Given is still stuck in the Suez Canal. Tugboats have not been able to free the 220,000-ton ship from its wedged position after it ran aground earlier this week. And now, reports say that the rescue effort could take weeks. Meanwhile, other ships are just sitting there waiting, and some shipping companies are actually considering rerouting their fleets altogether to sail all the way around the southern tip of Africa, a move that could add weeks onto the voyages. So why $9 billion? Well, this logjam is disrupting more than $9 billion worth of goods per day, according to shipping journal Lloyd's. Next, 684,000. We learned this morning The 684,000 people filed for first-time unemployment claims last week. And while that is a lot, it's significantly less than what economists were expecting. And what's more, that's the lowest level of the COVID era. It's the first time since the pandemic began that weekly jobless claims totaled less than 700,000. It's a sign that even though so many Americans are still reeling from the financial fallout of the virus, the economy is starting to head in the right direction. And finally, 200 million. President Biden announced a new vaccine goal today, 200 million COVID-19 shots in his first 100 days on the job. Biden's original target was 100 million shots in those first 100 days, but the U.S., well, it's ahead of schedule. We crossed that 100 million threshold as of last Friday. Get all the details from Biden's press conference, which was his first since taking the oath of office, by going to CNBC.com and downloading the CNBC app. And that's it for After Hours. We'll be back here at our home office every Tuesday and Thursday, so be sure to catch us then.